We're still in the grips of the worst drought in decades, and it's driven up food costs and added pressure on consumer prices caused by the rand's 25% fall against the US dollar last year. Now, South African consumers massively vulnerable, and the impact of runaway inflation, could we see that lead to social instability? This is the MoneyMakers. I'm Bruce Whitfield. I'm joined in our JSE studios this evening by Gina Schoeman, who's an economist at Citi Bank, on the crisis facing the South African economy. I call it a crisis. Do you, Gina Schoeman?
I'd certainly say so, but I'd also say it's a crisis depending on which income group you are in, because I think the topic of vulnerability, which you introduced, is very important at the moment.
Well, I mean, everybody's vulnerable. If poor people are hungry and hungry people are poor and their prospects are very, very limited, it starts making wealthy people sleep uneasily in their beds, surely.
No, absolutely, but we also must remember that this is a relative game, and it's a very finely balanced one in South Africa, but we do have the poorest of the poor and the richest of the rich on a relative basis. So by talking about vulnerability, where I'm getting to here is that you mentioned the drought, you mentioned food prices increasing. So we have rampant inflation above 6% at least, and the Reserve Bank's been hiking in response to that, which is the correct reaction, given that we cannot go with runaway inflation in South Africa, because while it impacts everybody, believe me, it impacts the poor to middle income households the most, particularly when food prices are going up. Our own forecasts show that while inflation on the headline index by the end of the year will be at about 7.5%, for low-income households, they will probably be dealing with 11% increase in consumer prices for their own baskets. And that's very tricky in a weak economy where politics are rife, let me put it that way, and trade union strength is still very strong, I would say desperate for relevance. You've already seen NUMSA come in today saying we want 20% wage increases. Why? Well, because the workers that they represent are in those low-income households. And that's what the Reserve Bank is so concerned about. That's what I'm concerned about, is that starts to push around that instability amongst low-income households. And that's also why the Reserve Bank goes on and on and on about a potential wage price spiral. So if you wrap it all together, the instability at the low end is much higher than at the top end. As a result, it is critical that we tackle inflation in South Africa with a gradual hiking cycle, even if that means that the pain then mostly goes to those in high-income households.
It's weird, isn't it? I mean, I was talking to the Reserve Bank governor on this show just last week. He came and sat in front of a studio audience of chief executives, and we were chatting about Molechi village, where he comes from in Limpopo. And he says he's got to protect the people of Molechi village because they are most vulnerable to that inflation that you talk about. You and I are going to feel the pain in our back pockets. But as you say, a relative game when it comes to taking that pain. We look at the indicators of stress appearing at the top of the economy. Gina, people who might watch this particular show, people who might be considering buying a holiday home or upgrading a car or even moving house, all of those decisions seem to be being deferred right now. Certainly, there are far fewer of those decisions happening in wealthier households than there were 12, 18 months ago.
Yes, certainly. Look, I'm not for a minute saying that the high-income households are not feeling a pinch. They certainly are, particularly the currency moves we've seen. Asset to liability ratios for the top end are still high relative to everyone else, but may very well be coming off slightly. However, if you think high-income households right now are feeling more uncertain or feeling the wealth blues as such, I can assure you that if this government had to allow the low-income households to fall into a state of instability, the high-income households in South Africa would feel even worse about it. But let's also just remember, we have a lot of problems in South Africa, but the high-income households do very much live like a developed market consumer. If you think about some of their indicators, they've seen real deleveraging over the last couple of years, from well over 100% debt-to-income ratios smashed down to about 75% now. And to be fair, most of that debt is made up by mortgage advances, so it's asset-backed. They've got something they can sell if they go belly up. Low-income households, however, we all know the story, has mostly been leveraging up in unsecured lending, largely personal loans that's not asset-backed. So should they go belly up, and they are extremely vulnerable to their disposable income, either through being eroded by high inflation or job loss, well then what would they do to pay off that debt? So those are just some indicator comparisons to say that yes, the whole consumer base is certainly feeling more vulnerable than before, but on a relative basis, and you think where policy decisions are being aimed at, I would say the vulnerability has built up so much amongst low-income households that is where policy decisions will be directed over the foreseeable future.
Now, this is crucial because you've got wealthy South Africans who seem to be escaping largely unscathed for the time being, but you've got a reserve bank that has got one weapon and one weapon only. That weapon is interest rates. Is too much expectation being placed on the South African Reserve Bank in the South African context, pretty much as we're seeing huge levels of expectation being placed on central banks all over the world to try reinflate economies, stabilize economies, and in our case, get inflation under control to a point that we can see a little bit of growth coming through. Too much pressure on the Reserve Bank?
Absolutely, Bruce. You've hit the nail on the head. I mean, the fact that we expect the Reserve Bank to try fix everything in this economy is just ludicrous. If you think about South Africa's economy, the reason why we actually have too high inflation, so inflation that drifts around that 6% top end of their target band of 3 to 6%, is simply because at the end of the day, inflation is the function of inefficiencies in any economy. And you think about South Africa over the last couple of years, we have just internally orchestrated our own inefficiencies. We are already grappling with huge global external headwinds for any emerging market commodity exporter, but at the same time we're lacking structural reform. Our labour market, our energy market, both on a supply and cost basis, is not helping South Africa to become more competitive, and as a result the currency will continue to depreciate to compensate for all those elements, to try give South Africa a bang for its buck when it sends something overseas in the form of an export. But obviously you need someone overseas who wants your product, and then very, very importantly, you need someone who wants that product at the right price. And you have to be able to produce it, which is again the problem coming down to inefficiencies. So I would say to expect the Reserve Bank, by purely through monetary policy, to try and fix inflation that is largely being driven mostly by these internal inefficiencies and only then slightly by demand, is asking too much. We need other parts of governments to step in, and that's stepping in for structural reform.
Yeah, I mean, again, and easier said than done. I made reference to this during the discussion with the governor last week. I was talking about the discussion I'd had with Mervyn King, the former governor of the Bank of England, and saying the world needs structural reform. This isn't just a South Africa problem, though, Gina. We've got increasing disparities between rich and poor across the world. In South Africa, perhaps we need a little bit of emergency surgery, but that's not to say the world doesn't have a structural problem too.
Of course, but at the same time, we can't fall behind in that. So if there are quick fixes we could do to this economy, such as the things that the rating agencies keep going on and on and on about, such as just introduce a secret strike ballot, because all the research done on this says that this would lower the incidence of strikes in South Africa. It would actually allow the workers to anonymously state whether they want to strike or not. And then perhaps you'll see less strike action and, of course, less threat of strike action, which also has an impact, never mind on just production outright, but also on business confidence and sentiment. And of course, announcing something so small, which is still reform in itself, will probably buy you some time with the rating agencies, which would help the outlook for the currency. So I would say that yes, the whole world is grappling with this, but there are some very obvious things that South Africa could do right now that could at least postpone uglier decisions that will be taken on this economy otherwise, such as a ratings downgrade, which would have huge implications for the currency, and then of course risk sentiment, and of course inflation at the end of the day.
And talk about currency and the currency, you speak inevitably of further declines in the currency. We've seen the rand have the most extraordinary year. Toward the end of last year, it went through 14, 15, 16, all the way out. It blew out to nearly 19 to the US dollar, retracing very close to 14 once again, and there or thereabouts between 14 and $15 rand to the dollar. I beg your pardon, it would be nice the other way around. Are we pricing in a downgrade in June, or are we quietly treading water?
Well, we believe that the near-term rand moves we've seen, so the slight strengthening against the dollar, we think it's just a near-term respite. I mean, it's at the end of the day, it's because of a backdrop of developed market central banks being more dovish. As a result, you get liquidity coming into emerging markets, and the rand will strengthen slightly, much like other emerging market currencies. However, at the end of the day, we think it's only a near-term respite, because once that turns over again, we must remember, firstly, South Africa's structural problems with its export sector, in other words, those internal inefficiencies I stated, which makes the rand keep compensating for it. But yes, we are pricing in as a baseline forecast that on the 3rd of June, S&P will move South Africa's foreign currency rating to sub-investment grade. And it's very difficult to calculate exactly how much is priced in, how much isn't priced in. Even the Reserve Bank has taken a stab at this, and they've said there would be somewhat of a reaction. We believe there has to be somewhat of a reaction, even just on the currency, because you cannot tell me that if a currency has its foreign currency rating move into sub-investment grade by only even one rating agency, that you wouldn't have a structural shift in the way that that currency is perceived in the risk appetite of market participants.
Now you got Pravin Gordhan travelling the world, telling everybody the positive South Africa mantra. Is he wasting his breath?
No, certainly not. I wouldn't say that. I think it's very important for institutional strength as one of the measures that the rating agencies use to see that, fiscal policy. So in other words, Pravin Gordhan and his team at the Finance Ministry are going around trying to ensure investor appetite for South Africa. At the same time, we've got the Reserve Bank in monetary policy talking hawkish, acting by hiking rates when they should, to show that they are tough on inflation, because inflation would erode this economy's GDP growth far more than just a gradual hiking cycle. And I would add, as a third pillar to that institutional strength, you've also had the Constitutional Court recently ruling against the Nkandla judgment. And that is, of course, altogether this wonderful measure of institutional strength that I would also add South Africa differentiates itself against many other emerging markets when the rating agencies do their assessment. But unfortunately, we are missing one fourth pillar. And that fourth pillar is government. Government stepping in with structural reform. Because at the end of the day, we've kicked this can down the road for many, many years now. And what the likes of S&P and Moody's and Fitch actually want to see in South Africa is some type of policy reform that ends up pushing the GDP outlook higher. So in other words, an improvement in the overall consensus of how South Africa is going to grow over the medium term. Are we seeing that yet?
Well,
certainly not.
To Gina, we must leave it there, but my thanks to you, Gina Schoeman, for joining us this evening. Gina Schoeman, economist at Citi Bank. And thank you also for watching. A lot of doom and gloom, but not all doom and gloom. Lots more money-making issues and the impacts, of course, for you to lose sleep over next time. Good night.